And the chart that you can see right there, this comes from Citi. They had a great note out yesterday talking about how capital markets will be the transformative factor when it comes to the oil supply. And if you look at 2014, free cash flow was negative $37 billion, which means operators are not covering their costs by their production, which leaves them completely reliant on the capital markets, which is what Lisa was just referring to.
Right, and the cost of capital is rising. And if you get a 25 basis point increase, it'll rise a little bit more for these companies.
Well, but it's not the Federal Reserve here that's dictating the rise in it.
It's the lousy economics of the oil business.
It's that some of these companies may not exist and may not deserve to exist. And so you've got actual investors saying that. So you have, yields on energy-related junk bonds that are above 12% versus about 7% for the rest of for the entire high-yield universe, including that 12%.
But to your point, Pim, Citi sees a doubling of cost of capital for the main shale players from about 7.5% now to 15%. And what they say is that could actually increase the break-even. Well, what you're looking at right there is the high-yield index and the energy high-yield index, to Lisa's point of just how much yield that investors are demanding to loan to energy companies. But if your break-evens rise, that's going to crimp producers even more. Part of the reason why some shale players have been able to stay in business is because their costs have come down so much, anywhere from 20 to 30%. If your cost of capital goes up, that negates the benefit of that deflationary cost curve, and therefore, what do? Citi actually sees potentially as much as 400,000, 500,000 barrels a day of oil coming offline as this trickles into the U.S. energy market.
Which could end up being a positive thing, because it could actually...
In their mind, yes.
Right, so eventually what you do have debt investors doing is going out and saying, look, which of these companies will survive, which deserve to survive, and which have assets that actually could be liquidated and potentially even return back the amount of money that we're going to pay for their bonds in the secondary market at this point. So you do have certain investment firms, BlackRock and Loomis Sayles, that have been going in there and selectively trying to pick out the sort of energy producers that they do like and investing in them.
And part of it is, of course, what's the oil price going to be? And you saw the EIA coming out today and cutting its forecast. Now they expect Brent to average $54 a barrel in 2016, $59 in 2016. WTI is going to be $5 less than that. Point being is this was one of the things that really led oil prices lower today, despite their revision for U.S. production lower. And this, in and of itself, tells the story.
And but got to admit, it's sort of like predicting the weather next year, right? 100%. Really, nobody knows what the price of oil is going to be, but people do know, as to your point, Lisa, that if these companies, exploration and production companies, do not have the cash flow in order to continue paying their bonds, we're going to see some defaults in these high-yield issues?
Well, we already have.
Yeah.
There have been 8 bankruptcies already this year, and there likely will be a significant amount of additional ones in the upcoming months. One thing that the investors who I speak to really talk about is the stability of the price of oil. You see that huge line down in the price of crude. It has continued to go down. There has not been a flatlining or any kind of, oh my God. Yeah, like,
it's okay.
Today. But that's what it would look like. But you know what? That's what it would look like over the past year.
Well, if you look back to last summer, you'd see a huge decline in the price of oil. So,
and it's continued to fall from there. So this is my point, is that people are not finding that stability, which will give them the ability to even value some of these companies.
All right. Thanks very much, Lisa Abramowitz from Bloomberg News, our bond guru. And my thanks also to my colleague, Alex Steele. I'll see you just in a little bit. All right. Now let's take a look at some of the top stories at this hour. Solera Holdings is close to a deal to sell itself for about $53 a share. This according to people with knowledge of the matter. Thoma Bravo and Vista Equity Partners are among the bidders. A strategic company may have also submitted a bid. A price of $53 a share would value the company at about $3.6 billion.